Thank you for joining. We're going to take about 1 minute here and let some more people join, and we'll be starting in about 60 seconds. All right, well, we'll get started here. Hello, everyone. My name is Andrew McGill. Welcome to our September webinar. We know how busy you all are, so we're grateful for you joining us here today. Today's topic and this month's topic is the basics of financial planning. I am a wealth advisor here at 12 Points. I'm joined here with Carolyn Mullins, and I'll let her say hello.
Hello, I'm Carolyn Mullins. I'm an associate financial planner here at 12 Points, and I work on a lot of the financial plans that we do for our clients, in which we're bringing you through a high level one today.
Awesome. And so just a little bit of background before we dive in. Some of you may be joining. We might manage your retirement plan or your 401k at work. You might be joining as a client on the wealth management side, or maybe you're a business owner as part of our 12 Points Business Advisors, but all of that is under one umbrella, under 12 Points. And what Carolyn and I do on a regular basis is financial planning, but really what we find that is helping people define, discover, and to live out what their freedom is. And what we mean by that is maybe you're looking to save up for retirement. Maybe you've just got to retirement, or maybe you think that you can retire and you're just not sure, or maybe you're already in retirement and you're like, what does the second half look like for me? Our goal is to be the judgment-free zone. For those of you who've been at our seminars at some of the companies, we say this all the time, but really the Planet Fitness of financial planning, we want to make sure that you feel as comfortable as possible when it comes to financial planning. And for that reason, our goal today, what I find is most people get the most anxiety around financial planning when it is they don't know what they don't know, and maybe they want to talk to someone about it, maybe they want to do it on their own, but they don't really know where to start. Okay, so what we thought would make some sense is that Carolyn and I will do a little bit of role playing here in terms of a financial planning engagement. I'll be asking some questions of her. She'll be telling me some things about herself, and then ultimately we're going to have a financial plan that we're going to show you. And then at the end, we'll tell you, I'll say stick around to the end, we'll tell you if the financial plan actually works. None of this information is actually necessarily your situation, but we want to give you an example of a financial plan. We will be monitoring the questions, so we'll keep this interactive. If you have any questions, please feel free to add them into the chat and we'll be taking a look at them. So with that, I'll turn that over to Carolyn and she'll set the scene for our conversation.
All right, let's get started. So as Andrew said, we're going to do a little bit of role playing here, building out a financial plan for these clients. So I'm in a couple, we're both age 65, we have a child age 30, and we've saved 1.5 million for retirement. Half of that is in a taxable account. You might have heard it called a brokerage account, individual, joint account. These are all different ways to explain the same type of taxable account. The other half, 750,000, is in a traditional IRA in which pre-tax dollars go in and we'll have to pay the taxes as we pull the money out. I am coming to Andrew today to ask him if I can retire. We're looking to see if we can pull the trigger there.
Awesome. So, and then before we really dive into all of this, the most important thing, if I put myself in the shoes of those listening, we hear all the time, like, it depends. Someone would say, can I retire? And a professional might say, it depends. What we want to walk through today is walking through a lot of the assumptions that go into financial planning so that you can start thinking about these things and take the it depends into actually getting some numbers. So we'll walk through that today. So why don't we go on to our next slide here. Carolyn, great to be connected with you. Great to have a conversation today around financial planning. I'd love for you to tell me a little bit about what would retirement look like for you. And I'm talking about think big. We're talking short-term, medium-term, long-term. Some things might be financial. Maybe it's traveling or downsizing or buying a vacation home. And perhaps maybe it's even trying a new instrument or whatever it may be. Tell me a little bit about what retirement would look like for you.
Yeah, absolutely. Well, let's see, the past 10 or so years, my husband and I have been very, very busy with work, stressed, and we kind of came to the point of, I'm kind of over it. We want more time to ourselves, and that's a big motivation behind this, is that we need some time to breathe. So with that, I see myself relaxing more, maybe sleeping in, and spending more time with friends and family who I might have been a little too busy to see as frequently as I'd like. That might be traveling. My husband and I definitely want to do more traveling in retirement since we'd have the time for it. I'd love to get into yoga. That is something that I've always wanted to do, but it never really worked into my schedule as well as I'd like. And ideally, I would like to volunteer more. That's been important to me, volunteering my time. I've been so focused on a paycheck that I would like to give back in retirement. When it comes to downsizing, we love the home that we're in right now. We don't plan on selling that home. The goal is to stay there, but I have dreamt a little bit about getting a vacation home somewhere in the Carolinas or somewhere down south.
Okay, I appreciate you sharing all of that. It's great that you've thought about these things. And tell me a little bit about, so you mentioned travel. How much do you think you're doing? How much are you doing right now in terms of travel? What do you budget a year for travel? And what do you think you would do in retirement?
Right now, as of lately, it's been smaller trips. It's been weekend trips locally, not so much flying to different places. And I feel like we've covered our bases there. And a lot of that was a time constraint. So if we're in retirement, we'd like to do bigger trips that take more time. And of course, that means more money. So I see us doing big trips, maybe not every year, but every other year, and big being 15,000.
Okay, so 15,000, understood. And when it comes to, one of the things I didn't hear was, and it's okay that we didn't hear it, family support. Is there anyone that you think you'll be supporting, whether it comes to your son or maybe it's parents that you have?
Right, my parents are currently in assisted living, and there's not much need for my help on my side. They've got that covered with their own savings. I don't expect anything from them. Then on my son's side, he is single right now, but eventually I hope that we'll have some grandkids. So I definitely want to gift to grandkids. I just haven't given it that much thought, considering it's not in the near future. But yeah, of course, that's something I'd love to do.
Okay, awesome. And stepping out of role play here, when it comes to retirement, it's in any kind of planning, if you don't have the end in mind, it's very hard to plan for. Whether you're taking a road trip or you're building something, you're trying to do a painting, like what you're trying to do, it's so important to be clear on what you're trying to accomplish. We find in financial planning that may change from year to year, but it's very important that you're thinking about these things, whether you're working with an advisor or doing financial planning on your own, thinking about some of the things, short-term, medium-term, long-term, financial, non-financial items. And just shifting gears here, jumping back into role play. So Carolyn, tell me a little bit about how much on a regular basis now, month to month, how much are you currently spending when it comes to your lifestyle costs? Do you have any sort of like a budget or anything along those lines?
I've used a budget in the past. Within a year or so, I attended something similar to this, and I used a classic Excel spreadsheet budget, and I did that for about 3 months. I didn't really get into the habit of it, so I haven't done it the past couple of months, but I did it for about 3 months and really focused in on my expenses. And I'd like to tell you that they're about $11,000 a month. But now that we just last month paid off our mortgage, we had our last mortgage payment, now it's looking more like $8,000 a month.
Okay, fantastic. Congratulations. And have you broken up your expenses in between like your fixed costs and variable costs, like perhaps like a credit card?
I'd say that the $8,000 a month now is a combination of both, considering what I see on my credit card statements. I'd say it's a combination of both, with the exception of travel. That's always something that is my extra piece, and it's treated separately. Okay.
I appreciate all that context. So, and we know that every month is very different. And to step out of role play, whether it's a budget that you have or there's different tools out there like Monarch Money. There's several tools out there that help you to organize your expenses, knowing what your fixed costs are, what your variable costs are, what costs are going to drop off in retirement is critical when you're doing the projections. Also understanding, again, on the month-to-month, if you are going to be, what healthcare looks like. What is your current health situation now? Do you anticipate it going to increase? What we typically see in retirement, and everyone's different, is we see kind of this smile effect where expenses actually start to, at the very beginning of retirement, they tick up because every day feels like Saturday. And then what ends up happening is they start to drop down more. You aren't doing as much things as you were doing at the very beginning of retirement. That drops down, and then what happens is in the second half of retirement, you see healthcare expenses start to tick up more. So it's really important in a financial plan to include all of those things in there. And just when you work with an advisor, you're putting in, you're doing your financial planning, it's important to know that these are just assumptions. These are just start with a baseline, and then you can tweak those numbers over time. And what we try to bucket everything into is your needs, which are going to be your living expenses, your wants, which are going to be things like maybe it's a car you're going to need every 7 years in retirement. And then there's going to be your wishes. That's going to be things like the second home, or it's going to be travel. Having a good feeling for all of that's very important. And that really leads us into our next conversation around, once you know what your spending is, having an emergency fund. So tell me, Carolyn, what do you currently have for savings? I know you told me about your taxable account, retirement account. Tell me about your current savings that you have right now, and what's the structure of that?
Right. So when it comes to outside of those two accounts, we have a savings account that we just keep cash in, and for the past, I don't know how many years, but we've just always kept 50,000 in it. That's just the number that we aim for. So that account is where our paycheck goes, and it goes up, we pay bills, it goes down, but we generally always try to keep that savings account at 50,000. Okay.
So 50,000. And everyone's different how much cash they like to keep on hand. I think the number one thing is having an emergency fund. That's number one. Number two, for a single person, we recommend having 6 months of expenses. And then for a couple, having 3 months of expenses. So if we use the numbers we used on our previous slide, $8,000, you multiply that by 3, we're looking at 24,000. So that would just be, in your situation, we would recommend having that. And not only do you have an emergency fund, but making sure that that money is in a high yield savings or some sort of mechanism where you are getting interest. We don't want that money just sitting there without growing at all. We are seeing rates are coming down a little bit as of late, with interest rates coming down. But that being said, it's still important that you are getting access to some sort of interest. The other piece in all of this is, when you are navigating retirement, there's a couple different elements here. So there's emergency funds for maybe you need a new home, a new roof, not a new home, that'd be great. A new roof, maybe it's your car breaks down, maybe you need new tires, maybe it's a health expense, something along those lines. That's critical. Then there's another piece of having money set aside for just the income that you're going to need, okay, to live off of. And we'll talk about that in a little bit, but that's also important to be considering that as well when you're going through financial planning and taking that money that you're going to live off of and move it into something that doesn't have a lot of exposure to the stock market, because there's a term out there, sequence of returns risk, that basically says in the first years, if the market goes down and you're taking money out of your portfolio, having to make up that down is much harder when you are taking money out of the account and it goes down. So being strategic there is incredibly important, things you want to think about when it comes to financial planning.
And Andrew, while we're on this, I do have a question about my son. So does this 3 to 6 months of cash emergency fund apply for him? He just used a lot of the cash that he had saved for a while on a down payment for a home, which is great. And he used what I would think is his emergency fund, and he has been prioritizing saving to his 401k. Should he rebuild that emergency fund? What should be the order there?
Yeah, it's a great question, one we get all of the time. So I think first off, that's congratulations to him. That's awesome in this market to be able to buy a home at his age is fantastic. And I think that the next step after you've used that money for down payment is starting to build back up that emergency fund. What we recommend is not only is important to know what your cash flow is, but from a savings perspective, you getting that full match, finding out what the match is, put the money in the match, and then reallocating some of those funds to be building back up the emergency fund. Because what we find more often than not, unfortunately, is that if there isn't an emergency fund, you, Carolyn, and your spouse become that emergency fund. And teaching that and encouraging that is very important. And the other place we see folks go to when they don't have an emergency fund is a 401k loan or taking a distribution, when that is the last place where we look for people to be taking from. Although you are borrowing your own money for tax purposes, it does not end up making a lot of sense to do that. So yes, having an emergency fund, trying to get him to build up 6 months, turning that down to just a match is incredibly important. So the next piece, Carolyn, tell me a little bit about the income sources that you have. I know that with many clients, we talk with a big anxiety of when you get to retirement, it's like, okay, I've received all this income my whole life. I never had a problem for my payroll paying me. Now, okay, this is stopped. What do I do now? Most people would look to Social Security to fill that gap. And we find that sometimes works for folks, but optimally you can see after 65, Social Security is growing at 8% a year, which is a great growth rate. So helping someone to navigate their income in retirement, I think, is very important, and it can relieve a lot of stress. So let's start there. Tell me about what your income sources are going to be in retirement.
So this statement does look very familiar. I've been getting a Social Security statement for a couple years now. I see the numbers of what my benefit would be. I don't think my husband's eligible. He hasn't been receiving a statement, so I really don't think we'll have his. It'll just be mine. Other than that, no pensions or rental income. We really just expect the rest of our money to come from our portfolio.
Okay. And on that same note, once you file, if your husband's not eligible for it, he can get half of your benefit. And secondly, you can go right to, for those of you who do not know on the call, you can go to right to ssa.gov and sign up on the Social Security website, and you'll be able to get this form and this document that walks you through what your benefit would be at whatever age you take it. That's in today's dollars. That has gone up in the past, so you just want to make sure that you keep an eye on that. Secondly, taking a look at what is the pension that you potentially have. Not many companies have pensions these days, but if you do have a pension, really understanding, does it make sense to take the single life payout on the pension, or does it make 50% with your spouse? Looking through all those options is very critical. You may have an annuity. Understanding, you may have just seen that annuity as something that's just growing on the side. Is there an income rider on that where you can turn on income, and what are your options there? Is that annuity out of the surrender period, or does it make sense to go to the market and see what you can get for payouts from your annuity? All these things can be considered. And the other piece is, a lot of times folks have a lot of apprehension of taking money from their accounts that they've saved up in. So for instance, maybe they're all of a sudden really worried about taking money from their 401k or taking from their taxable account. A lot of times it makes sense to be taking from those buckets first before taking from Social Security, and that's something different for every single person. But it's really important to kind of get a good picture of that and understand what is the style of retirement income that you want. There's different tools out there that can help you with that. Do you like guaranteed income? Like, do you like having money coming from a pension? Do you like the idea of Social Security? Are you willing to give up upside in your portfolio to be able to get a guaranteed amount of money coming to you, similar to a paycheck? Would you rather take a little bit more risk, take money from your portfolio, keep that money invested? Do you want to, there's different bucketing strategies of having money in cash, taking a little bit more risk on the midterm and then long term. All these things should be considered when you are going through financial planning. So that's it on the income sources. Other than, it's important to understand what you're spending, what are the income sources, and then coming up with a plan for figuring out what that gap is. Just to take a step out here, we don't have any questions, so we'll keep going. If anyone has any questions, please feel free to jump in. Investment allocation. So Carolyn, tell me a little bit about how you're currently invested inside of your portfolio. And if you don't know, that's perfectly fine.
Okay. My IRA has been in for as long as I can remember. It's in a 2025 retirement target date fund, I think they call it. And I know it's the 2025 one. Then my taxable account is something that my husband's played around with over the years. So I know that there's some companies he's invested in, some specific stocks that have done well, done worse, but that's more his realm, and I couldn't tell you exactly which ones or what else is in that account.
Okay, totally understood. And the reason why we want to know this is really going to get a feel for how your current portfolio is invested. Is it being currently invested conservatively? Maybe it's kind of right down the middle, moderately, or aggressively. And based on that, you can make projections on the type of rate of return you would expect with not only now, but all the way to retirement. And really getting, how would you say, would you say that you're more risk tolerant or risk averse, Carolyn, when it comes to investing?
I'd say we've been risk tolerant, but the past couple years thinking about retirement coming so soon, and now that we're officially talking about it, I'd stray more on the conservative side now that we're going to be pulling from the portfolio. Okay. That scares me.
And how about on April 2nd, when the market, which was like quote unquote Liberation Day, when the market went down, how are you feeling then?
It made me a little queasy. I did not like that at all. It didn't make me feel good.
Okay, and did you make any changes in your portfolio?
No.
Okay, so you kind of stayed the course and wrote it back up.
Right.
Okay, and tell me a little bit about you've mentioned at the beginning some of the types of the accounts that you have. Have you been strategic in saving in specific accounts?
Well, we used to save more into the traditional IRA, and then later in our careers, we kind of switched over to putting more into our taxable account.
Okay, So putting more on the taxable account. All right, yeah, that makes a lot of sense. So when it comes to retirement planning, it's not only important to have money saved up in your accounts, but it's important to figure out where that money is located. So is it in an IRA? Is it in a 401k? Do you have a Roth IRA? Do you have a taxable account? So as Carolyn mentioned on the front end, stepping out of role play, the IRA, that would be money coming, would be pre-tax. There was no tax paid on the front end. When you take the money out at retirement, that you'd be taxed on that money. Roth IRA, you were already taxed on the front end. There's no tax when you take it out. Taxable account, that you're going to pay when that money comes out, you're going to pay capital gains, short-term or long-term, depending on how long you've held that investment. And what a lot of times people will get mixed up with when it comes to retirement income planning is they don't realize that if you're able to take from different buckets, what you can do is lower your taxable income. So for instance, in the first year of retirement, is if you took money from, let's just say, you took 50, you said, I need to live off of, I have my pension that's coming in or annuity that's coming in, but I'm going to need $50,000 from my portfolio. If you were to take $50,000 from an IRA, and then you were to go to your savings account and take $50,000 out, the IRS is only going to treat the $50,000 from your IRA as taxable income. I bring that up just because making sure that you're being smart about what buckets you pull from is incredibly important. And Carolyn mentioned putting more money into taxable. Long-term capital gains, which is when you have a stock or any position that's held for more than 12 months, you're going to be taxed at between 15 to 20%, which is normally lower than a tax rate than if you were to take money out of an IRA. So knowing where your money is in each account, if you are in a position where let's just say you are 55 and you're looking to save up all the way until retirement, you're planning to retire at 65, it may make sense to look at putting more money into a taxable bucket so that you diversify what the tax treatment is going to be on those dollars. Then there's another piece of, in the first years of retirement, when you are taking, let's just say you do what I mentioned before, maybe you're taking from an IRA, maybe you're taking from a savings account, considering doing things like Roth conversions, which is basically taking money from a Roth IRA, telling the IRS you're going to take it right now as a distribution. I'm going to say that's going to be my income, but then you're going to take that money and put it into a Roth IRA.
From a traditional IRA.
Excuse me, thank you, Carolyn. Put it from a traditional over into a Roth IRA. You're going to be taxed on that money, but you have to be thoughtful in terms of what is your total income so that when that money goes into the Roth IRA, it's going to grow tax-free for as long as you don't, it's going to sit in that account growing tax-free. When you take it out eventually, you're not going to pay tax on it. So that's something when you first get to retirement, it's important to think about. The other piece is when you get to retirement and you start taking income, depending on the taxable income you have, your Medicare premiums can be impacted. So there's something called IRMA brackets. So understanding what that threshold is of what taxable income will generate the Medicare premium. You want to make sure that you are considering that. And actually IRMA, which is that Medicare premium, looks 2 years back at your taxes from 2 years ago. So when you get to retirement, there's actually a form that you can fill out, Social Security 44, where you can go in and say, in this year, I've now been retired. I don't have any of the income coming in previously, and they will actually lower down that Medicare premium. That's something you definitely want to consider once you get to retirement. And unfortunately, it's an opt-in sort of situation where you have to go in and fill out that form when you get to retirement. So something to consider. Also, require minimum distributions. Once you turn 73, you have to, if you're not working, you have to start taking money out of your IRAs and 401ks, okay? Or that could be a 403b. If you are working and you are at your company in a 401k, if you continue to work past 73, you don't have to take them. but you do have to take them if you are not working. So what's really important is that you want to come up with a plan to potentially take some of that IRA prior to the required minimum distributions in your overall plan, because what you don't want is the IRS to start telling you, you have to take out this amount of money out of this account, and now you're forced to have that tax and forced to have that income. So it's very important to plan out those years prior to 73 and just planning for that matter. We don't have any questions here in the chat. So Carolyn, tell me a little bit about we're moving into risk management. Right here on the screen, we're talking about different types of insurance, but tell me a little bit about the insurances you currently have.
We do not have life insurance anymore. That's something that expired a couple years ago. I remember that. Health and disability we've always had through our employers, but as you mentioned, Medicare starts at 65. So whenever we do retire, we plan on going Medicare. Long-term care insurance, when I look at my parents right now in an assisted living home and see how expensive it is, I'm definitely interested in long-term care insurance. I don't know if it's too late or when the right time to apply for that would be, but that is something that I should probably do.
Okay, yeah, and that's something. There's some people who self-insure for things like long-term care, which long-term care insurance is protecting you, and it kicks in when you're unable to do 2 out of the 6 forms of daily living. And what those are is bathing, dressing, eating, transferring is the ability to move from one position to another, toileting, and continence. So that would be going to the bathroom. So that what we see is that a lot of times these days, the costs of, as you mentioned, the cost of assisted living, the cost for things of helping parents for that can be very costly, not only for one person's financial plan who's going through it, but also can sometimes be for kids. So thinking those things through, not only do you have the right things set up, but how are parents set up for things like that, and having those conversations. Down in the bottom left, you have disability insurance. That's going to be if you are unable to do the duties of your job, a disability insurance policy would kick in and cover you. Where life insurance is, if you were to pass away, the insurance company is going to pay out a certain sum amount to you, and ideally to not necessarily make you whole emotionally, but try to cover the expenses and the things that you would have been able to have if that person was living. All of these things, you want to make sure you check and see what you have through your employer. Take a look at that in open enrollment and look and see if it makes sense for you to be getting coverage above and beyond the coverages that you have through your employer. Last but not least, understanding your health insurance. What are you going to be covered with, not only while you're working, once you get to 65 and you start looking at Medicare, really thinking about what are the prescriptions that I'm taking. If you are taking them, is the insurance carrier going to cover those things? And there are plenty of professionals out there that can help you through that. And that's very important to take a look at, because health insurance is very, very important when it comes to retirement. And perhaps your spouse can continuing to work. It's important that even if when you do turn 65, if your spouse is working, it's important that you do sign up for the Part A. All you have to do is sign up. That's important. And looking and understanding what your different health options are. And sometimes, in some cases we've seen, actually COBRA might make sense before going on Medicare, or covering that gap between when you stop working and being able to go on Medicare. These are all things you want to be thinking about. Carolyn, do you have any questions?
Yeah, does my son need life insurance? Trying to remember when my husband and I first got our life insurance, and my son's 30 now. Yeah,
so it's a good question. Love to say it depends on his situation, but I will just tell you some keys on that. We see often folks at that age getting insurance if they want to protect things like maybe they have student loans that they want to make sure that, God forbid, they were to pass away, if they were private loans. They would want to make sure that those things were covered. If they have dependents, I don't know what your son's situation is, but covering those things. But I think the number one thing is first understanding what they have through work. Sometimes at work, you're able to buy supplemental coverage. That's something you want to take a look at. And then ultimately running projections to say, like, if God forbid your son were to pass away, understanding what the implications would be of what the plan looks like if he has dependents. So I think number one, finding out what he has through work, and then figuring out, are there other things which you would know if there's things like student loans that you want to make sure gets covered, God forbid he were to pass away. So that is that piece. And next piece in financial planning, whether you are 30 years old, you're just starting a family, or you've gotten to retirement, it's really important to be considering estate planning, which can be, we have one question here. I just want to make sure that we are addressing that. Would it be a good idea to have a life insurance with a long-term care rider? So the answer to that question is yes. If the it's very important. There's different types of long-term care insurance. There's standalone. There's life insurance where you have something like cash value life insurance. Some call it whole life, where you can add on a long-term care rider. Sometimes it can be more. I think it first makes sense to look at the life insurance and understand what your need is there, and then see what the company would offer for the long-term care rider. Sometimes it might make sense to just have a standalone policy with the long-term care. But yeah, we've seen that many times, and it makes sense. Oftentimes when folks do this at a younger age, it can be very beneficial. But yeah, that's a great question. So on the estate planning side, this is something that most people do not love talking about, but it's something that's very important. When it comes to estate planning, I'll just start with, everyone should have a will. So that's basically, a will is, it makes sure that the assets go where you want them to go, and they are, and the right person is handling the things. God forbid you were to pass away earlier, or when you do eventually pass away. Then there's something called trust. When you're younger, trusts aren't necessarily the most important thing. I would look at things like healthcare proxies, advanced directives, powers of attorney, things like that. But what trusts will do, there's revocable trusts, which are flexible, and it allows you to avoid probate. Okay. And when I say you, I say that your family members and the people you love who are, if you do pass away, and when you do pass away, they're not having to deal with the probate process. Trust can help you avoid that. Where you also have irrevocable trusts, that's going to move your money completely out of an estate. It's going to create for some liability protection. But I oftentimes recommend first starting with revocable trusts and creating that flexibility within your overall planning. Next piece is power of attorney. So this gives someone you trust the ability to handle your financial and your legal matters if you're incapacitated and unable to do so. You then have healthcare proxy and advanced directives. That's naming who you want to make your medical decisions and really spelling out who that is. And then one of the things oftentimes when people don't think, when they have kids going off to college, or maybe they're in college, making sure that your kids have these things. So once a child turns 18, the parents don't automatically have authority anymore when they go off. So having those things so that, God forbid, something were to happen to your child, maybe they're going to school in another state, making sure that they have these things so that you can make decisions for them if they're in a hospital, wherever their college may be. I even cringe even talking about these things, but it's really important when it comes to planning to be considering these items. So with that, Carolyn, we can move on to, we'll check and see if there's any questions here. Let's see. What age should you have a will or trust? So what we recommend is, for wills and trusts, having that a good time, a trigger for that is when you have a family, when you have a have a child is a great time to start having those conversations. Our team could connect you with someone if that's something you're interested in. But when you have dependents, God forbid something were to happen to you, and perhaps you have a spouse, making sure that your child is taken care of the way you want them to, and then also make sure that your assets and everything is set up in a way that how you would want it if you were living. So there's a piece of making decisions while you are living and maybe you're incapacitated. The other piece is when you're passed away, and you want to make sure that the money is, you've saved up all this money your whole life. You want to make sure that it's done, what's done with it is done properly in the way you would want it. Checking for any other questions here. I think we are good. Okay. So in summary, making sure all the pieces, I know we threw a lot at you here during the conversation, but what we want you to do is start understanding what are some of the things that you would be asked if you went through a formal financial planning engagement. Perhaps you want to just do financial planning on your own. I wish you the best in doing that. Either way, how you do it, just want to make sure that you know some of the things you should be thinking about and what you can expect, so that you're not going to any of these situations blind. And so with that, I'll turn it back over to Carolyn. And for those of you who only stayed on for Can I Retire, we want to run through that.
Right, so we told you we were gonna give you guys an answer on myself and my husband and if we could retire or not. So after going through all of those deep dive questions, some assumptions that we came to the conclusion of was I've got $750,000 in a taxable account, $750,000 in a traditional IRA. For the sake of this, we're gonna assume 60% in these accounts is stocks, 40% is bonds, spend $8,000 a month or $96,000 a year, traveling every other year for $15,000 because I talked about that. And then we left this placeholder here for a down payment on a vacation home. And that's totally for what if scenarios, we like to call them, on what if I do this, what if I do that, what does that look like? So we didn't include it in our base analysis, but we know that the client would like to explore that. The spouse one gets $52,000 in Social Security benefits, filing at age 70, and spouse two gets 50% of spouse one's benefits at spouse one's full retirement age, their full benefit at 67. So that's $21,000. And then we're planning for them to live to 92 and 94, an inflation rate and a rate of return assumptions. So got to disclose all these assumptions. And then the result is 97% probability of success. And what does this mean? So after going through all these questions, we have this financial planning software that we use to help come up with this number. And we put all this information we just went over and much, much more into the software. And it knows everything about the clients. And it can project income, and it can project expenses. It'll grow your nest egg. It'll pull money out for different things such as travel, and the only thing it can't compute is what the market's going to do. So it picks a random market return every single year now until the clients pass at the end of their plan. And it does that and sees if there's any money left over. So does their plan work and there's money left over? That's a success. And it does that 1,000 times. So on the right, when you see 816 successes, that's out of 1,000 different random market scenarios. How many times was there $1 left over in their plan? Never including the home. And so the right is just an example, squiggly lines of all the trials, but for our actual scenario that we went over today, this client's at 97%. So 97% of the time, there was money left over at the end of their plan, at the end of their life. So we can pretty confidently say with 97% chance that you can retire.
Awesome. And I think with this is, again, with financial planning, it should be reviewed on a regular basis to always know that all these assumptions can change. And ultimately, you should be leaning on putting in new assumptions in, understanding, figuring out what you can do and what would be the ultimate retirement for you, and figuring out could I stay at that 97%? I'm looking at that. I did want to come out. We've coming up at 12:45 here. Our call to action is ultimately to this. Financial planning in general can be a bit overwhelming. We hear that a lot. My hope for everyone is to kind of just start that process, start going through these things, getting things organized, and then whether it's us or it's any other financial advisor, just making sure that you're talking through all these different items and incorporating that into your plan, and then continuing to revisit it, because as I've said many times now, all these things can absolutely change, and making sure you continue to revisit that. So that is the formal end of our webinar here. We have a couple extra questions. I know we plan till 12:45. I'm going to take these here. So thank you all for joining. Just want to make sure we're conscious of time here, and I'm just going to go through some of these questions here. So what about Medicare? So Carol asked, what about supplemental plans along with Medicare? I remember my mom had that and it was expensive. So the answer is yes, they can be expensive. What I would tell you is that really comes down to the different types of services that you're looking for. We actually have a resource. If that's something that you would want to talk to someone about, we can make that connection to them to do a free consultation just to explain with you the marketplace. I would recommend doing that, and we can talk in more detail there. Pete asked about discussing gifting limits. Happy to do that. So this is a conversation for another time, and Pete, we could even talk offline if you'd like. But every person is on an annual basis. You can put $19,000 that can go towards gifting and giving towards whatever it may be, a charity, or maybe it's to a person that you're giving to. As an individual, $19,000, and that would not count against your annual or lifetime, your lifetime exclusion. And when I say lifetime exclusion, there's a Massachusetts lifetime exclusion, and there's also a federal estate tax lifetime exclusion. All this jargon is to say that there is a cap, and whenever you go over that cap in Massachusetts right now, it's 2 million. For federal estate, it's 13.61 per person. If you go over that, then the money that you've left for your heirs would be exposed to estate taxes. Okay, so you basically get you have an annual coupon of the 19,000, and you can actually combine that with your spouse to get to the 38,000, an annual amount, an annual limit, and then you have a lifetime exclusion. You want to make sure that you are staying under that 19,000 so that you don't have anything that comes away from that lifetime exclusion. Be happy to spend more time talking through that in your situation. All right, the next question was, would it be a good idea to look at money in retirement for Social Security purposes as taxable? How would traditional Roth plans help me towards that outlook? Yes, so good idea to look at money in retirement for Social Security purposes. Yes, it definitely would be good to look at that. Hopefully I'm answering your question right, but the amount that your Social Security is taxed is based on actually the other income that you're taking. So number one, as we said before, make sure you understand your whole picture of the different accounts that you can pull from and you can take from. Understand when it would make the most sense for you to take Social Security. When you do take Social Security, that can be taxed up to 85% depending on the other income that you take. And so, for instance, you're taking from Roth IRAs would not count towards the taxability of your Social Security. You want to be very clear, because that would not be taxable income. Are you planning another session for perspective for a 40-year-old? We will continue to share more information on financial planning in general, and we can also be happy to set up some more time, Theodore, if you want to set a one-on-one meeting. Everyone needs to get life insurance now. If you get cancer or terminal diagnosis, you will not be approved. Yes, so that's very, very important. There is always the case and the risk of you getting some sort of diagnosis. So thank you, Matt. And Theodora, yeah, okay, my pleasure. Let me just look here. All right, so that does it for our questions. Thank you those who stuck on. And this will be recorded and will be shared with anyone who has signed up. So thank you all for joining. We look forward to seeing you next month for our next webinar. And you can see our emails here below. If you want to reach out, just to have a conversation, be more than happy to do that. And we're grateful for you joining us here. Have a great rest of your day.
Thanks, Andrew.
Thanks, Carolyn.